Today, macroprudential, transparency and common prosperity. The DFA Daily to the 28th of September 2021. Hello again, it's Martin North from Digital Finance Analytics. Welcome to this post covering finance and property news with a distinctively Australian flavour. In today's show, we discuss reports that the Treasurer has agreed to allow a clampdown on high-risk mortgages, more disrespect from the government, and further thoughts on what Evergrande may mean in the months ahead. But first, as I've been highlighting, there are significant pressures on mortgage borrowers, with more than 42% under cash flow stress. And due to the rise in home prices compared to income, more than 1 in 5 home buyers are now borrowing at more than 6 times their incomes. And that's, of course, a risk which could be felt if interest rates jumped or if people lost their jobs. In fact, in Sydney, the ratio is even higher. Indeed, the number of new residential mortgage loans where debt is at least 6 times greater than income jumped to 22% of new loans in the June quarter from 16% a year earlier, according to data from APRA. The largest home lender, Commonwealth Bank of Australia, increased its interest rate buffer in June to 5.25% from 5.1% to assess people's ability to repay loans if interest rates rose. Chief Executive Matt Cummins suggested last week that regulators should force other banks to follow. We think it would be important to take some modest steps sooner rather than later to take some of the heat out of the housing market, he said. And the IMF's biennial check-up of Australia's economy raised concerns about housing affordability problems and the potential for rising financial vulnerabilities. Structural reforms to boost housing supply and targeted support for low-income households are needed to improve housing affordability, the IMF noted. Macroprudential policy should be tightened to address gradually rising financial stability risks. While the surge in housing prices has been largely driven by owner-occupiers taking advantage of low mortgage rates and fiscal support programs, high debt-to-income mortgages are on the rise amid elevated household debt, and investor demand has begun to increase from low levels. Lending standards should be monitored closely, and macroprudential measures should be employed to address incipient risks. Options include increasing interest serviceability buffers and instituting portfolio restrictions on debt-to-income and loan-to-value ratios. But now, according to a report in the AFR, Treasurer Josh Frydenberg has given the green light to regulators to crack down on high-debt home loans to reduce financial risks from record low interest rates and surging property prices. Financial regulators are working on plans to potentially clamp down on a jump in high debt-to-income ratios among new borrowers, a trend exacerbated by ultra-low mortgage rates, enabling home buyers to borrow larger amounts. While regulators will not target house prices or affordability, debt-to-income is a key benchmark are scrutinising, and they could apply so-called macroprudential tools. Frydenberg told the Australian Financial Review that low interest rates had contributed to strong growth in housing markets in Australia and overseas. A positive feature of this housing cycle compared to that of the last is a higher proportion of first home buyers and owner-occupiers entering the market, he said. With Australia's economy well positioned to strongly recover as restrictions ease, it's important to continually assess the appropriateness of our macroprudential settings. We must be mindful of the balance between credit and income growth to prevent the build-up of future risks in the financial system. Carefully targeted and timely adjustments are sometimes necessary, and there are a range of tools available to APRA to deliver that outcome. Frydenberg spoke about the issue to the Council of Financial Regulators at its quarterly meeting last Friday. The CFR is chaired by Reserve Bank of Australia Governor Philip Lowe, and its other members are the heads of APRA, ASIC and the Treasury. No decision has been taken, and any announced crackdown could be some weeks or months away as more lending data becomes available and regulators fine-tune potential measures. Regulators face a tricky balancing act to avoid unduly hurting first home buyers. Investors have overtaken first-home buyers, in fact, in taking out home loans in recent months, but investor lending remains well below levels recorded between 2014 and 2017, when APRA cracked down on investor and interest-only loans. Those measures are unlikely to be repeated, with rising debt-to-income now a strong area of focus. Investors tend to have higher debt-to-income than owner-occupiers because investors often have multiple properties, including the home they live in. The Reserve Bank of New Zealand was recently given new powers to limit high debt-to-income ratios, but was directed by the government to target investors and not first-home buyers. The Reserve Bank of New Zealand found that a DTI restriction of 6 or 7 would have little impact on first-home buyers, but would significantly impact investors. APRA and the RBA have made it clear that it's not their job to tackle house prices or affordability, but they are mandated to act if home lending poses risk to the financial system or economy. And overall housing credit has been growing at an annualised pace of about 7% in recent months, more than double the rate of income growth. Michelle Bullock, RBA Assistant Governor in charge of the financial system, said last week the strength in the housing market is positive for the economy and an important channel for monetary policy to support the economy through housing construction, home improvements and purchases of household items. However, while household debt to income in Australia hasn't increased much over recent years, it is at a high level, both historically and relative to other countries, she said. So sustained strong growth in credit in excess of income growth may result in vulnerabilities building in bank and household balance sheets. And APRA Chairman Wayne Byers said at the Australian Financial Review Banking Summit back in March that on his radar were signs that housing credit growth is picking up and likely to outpace income growth for the foreseeable future. Council of Financial Regulators is due on Wednesday to release its quarterly statement, though it's not expected to announce any macroprudential measures. But let's be clear, shall we? The CFR, including the Treasury, RBA, APRA and ASIC, as well as other hangers-on, absolutely have no suggestion of independent thought. They are all in the same tent, which means political influence of both the financial regulator and the RBA are alive and well. And if you continue to believe the neoliberal view that the private sector should be given full rein, don't expect much soon in terms of macroprudential tightening. That would be a big problem because we need it and we need it now. Now, the New Daily has a disturbing story saying that Australia's peak legal body has savaged the federal government's plans to block national cabinet meetings from scrutiny, saying there is no justification for the move. Other esteemed constitutional lawyers have slammed the Morrison government's plan as bizarre, while even the federal commissioner responsible for upholding freedom of information, the FOI laws, has questioned if the changes set a dangerous precedent. It's just a mess, and it shows disrespect for the people, for the courts, everyone, to go around asserting in legislation things that aren't true, said University of Sydney academic Professor Anne Toomey. The federal government's COAG legislation amendment bill seeks to extend provisions to protect from disclosure the deliberations and decisions of the Commonwealth Government's federal cabinet to the National Cabinet of State and Territory leaders. Federal cabinet meetings and documents have a blanket exemption from FOI requests, and documents are only released after 20 years of secrecy. But following an application from Senator Rex Patrick, the Administrative Appeals Tribunal recently ruled the National Cabinet did not enjoy that same exemption, and therefore documents for the meeting of state and federal leaders could be requested under FOI. The federal government claims it is critical that National Cabinet must have the same protections so as to enable full and frank discussions, and maintains Prime Minister Scott Morrison has the power to simply declare it as a subcommittee of the federal cabinet. A Senate committee investigating the legislation held its first hearing on Monday, with Professor Toomey appearing alongside government accountability experts and government departments. Appearing in a private capacity, she said National Cabinet simply was not a federal subcommittee, therefore should not be treated as such. It's frankly bizarre legislation. I mean, why would you assert something that's not true? Why would you say in legislation that a cat is a dog or vice versa? Toomey told the inquiry. Really, you've just got to ask yourself, what's the government's aim here? If the aim is to keep certain information confidential, they can do that by just changing the FOI Act. Professor Toomey warned of a cascading level of non-responsibility, warning the legislation would allow the federal government to simply deem any group as a subcommittee of cabinet and effectively shield it from outside scrutiny. And she said this could even extend to external groups of business leaders or union officials. The further you down the food chain, the less sense it makes. You could choose any of those bodies and make them a secret, Toomey said. I don't think I want to keep things secret is a good enough answer. And she called the legislation pretty bad. In its submission, the Law Council of Australia, the legal profession's peak body, said the proposed changes go too far. There is an absence of meaningful justification for applying an absolute exemption based on the status rather than the substance of information, Law Council President Dr. Jacoba Brashka said. Existing FOI exemptions are already adequate. Under these exemptions, national cabinet documents would not be released if the harm it would cause to specific national interest outweighs public interest. And the Law Council's submission accepted that there may be merit in encouraging candid discussion at national cabinet and suggested a limit of 5 years instead of 20 on secrecy. The Office of the Australian Information Commissioner, the regulator for privacy and FOI requests, told the Senate hearing that it had not been consulted by the government over the changes. Commissioner Angela Falk called the changes broad and uncertain, echoing Professor Toomey's concerns that the legislation could see any group given the protections of Cabinet. She noted that broad exemptions around factors like national interest could be applied to national cabinet documents if they were requested, suggesting the current system of FOI exemptions was adequate. Ms. Falk also recommended the body should have a proactive requirement to publish data in a timely manner, including meeting minutes, summaries or documents considered. But the Department of Prime Minister and Cabinet, appearing last in the hearing, maintained it believed Mr. Morrison could designate National Cabinet as a federal cabinet subcommittee. Therefore, departmental officials argued National Cabinet should enjoy the same privacy conditions as the federal cabinet. What Schedule 3 of the legislation is seeking to do is give effect to the government's decision in March last year to establish a committee of cabinet, Department official John Reid said. Another official, Lenny McGregor, said the department believed national cabinet operates in a similar way to federal cabinet and should therefore have the same protections. And the department's submission to the inquiry said confidentiality for national cabinet deliberations was critical to its effective operation. In terms of our relationship with our state and territory counterparts, it has created a lot of uncertainty, the department's Lee Steele said. We're trying to manage that uncertainty to not result in harm in terms of having a chilling effect on the discussion that First Ministers have in National Cabinet. DPM&C officials said they've received instructions to draft the bill in late February. Senator Patrick lodged his application to the AAT on February the 25th, and Senator Patrick became angry when officials would not say whether FOI decision-makers in the department were now making decisions on requests in the light of the AAT's ruling. He told the department's representatives to not waste the committee's time and stop the crap. Now to China. There's a Bloomberg Businessweek article which says that in the past few months, China has been pushing for common prosperity, which means reducing income inequality and reining in billionaires. Instead of shareholder capitalism, China is talking up stakeholder capitalism, where customers, employees, and even local governments have a say in how companies do business and distribute their earnings. Before President Xi Jinping woke the nation to its socialist roots, one billionaire was already talking about and acting on them. That man was Hu Kai-yan, founder of China Evergrande Group, the world's most indebted real estate developer, now on the brink of collapse. Hu, a party member for more than 35 years, used the Common Prosperity slogan back in a speech in 2018. For years, he was ranked as China's most charitable person, donating billions of dollars to good causes such as medical research. When Evergrande was starved of cash, it wanted its employees to become stakeholders too. Earlier this year, it nudged them to give it a short-term loan or risk forfeiting their bonuses. Now, hundreds of workers have joined panicked home buyers to demand their money back. China's real estate business always had a bit of stakeholder capitalism. To buy land, developers often borrow from trust companies, which in turn ask senior management responsible for that project to become investors in that trust project. Construction and mortgage loans from the banks come only much later. Only 5 years ago, trust products that invest in Evergrande projects could offer 30% annual yield, according to local reports at the time. But as Evergrande grew bigger and became more financially stretched, co-investing trickled down to mid-management and eventually to lower-tier worker bees. Financial terms got worse too. Wealth management products that Evergrande sold were offering only 5% to 10% yields. In addition, those products weren't necessarily tied to the housing project the employee worked at, which means they had no idea about the quality of the investment their money went to. In the debt restructuring, a company can still operate normally while creditors and shareholders haggle. Employees can still lead a normal existence as long as they get paid and not laid off. But Evergrande's strong-arm nudge changed their lives. Now they're also creditors who are stacked against powerful banks and have no idea where they are in the pecking order. No wonder some went into the streets to protest. Proponents of common prosperity say that a business needs to share some of its profits with its workers. That's noble, but China's policymakers also need to be mindful of a corporate culture that's addicted to debt. Evergrande has borrowed from everyone, its customers, employees, suppliers. Common prosperity can turn into shared poverty very quickly. So then, where to from here for Evergrande? Well, Investor Daily says that while the Chinese authorities are not expected to allow Evergrande to mushroom into a full-scale credit squeeze, reports have suggested the high end of town could be trickling money as investors begin to turn their backs to major fund managers. Fidelity International Fund and BlackRock China Bond Fund are reportedly losing investors, with as much as $95.3 million US and $37.9 million US respectively withdrawn from the pair in the week ended Wednesday. Those record withdrawals are the first signs of an investor exodus on the back of Evergrande fears, which have also rocked stock markets since news of the ailing company's financial woes intensified last week and talk of a Lehman Brothers-like scenario circulated. Uncertainty is still high as the world awaits word on the missed $83.5 million US payment deadline last week, and as China perceivedly braces for economic backlash with an injection of 120 billion yen or $25.5 billion into the banking system. Acknowledging that last Thursday's payment deadline did come and go amid a disconcerting silence, Shima Shah, chief strategist at Principal Global Investors, believes that the current declines following Evergrande bondholders' tumbleweed experience are not the precipitous falls of a week ago. At the moment, the indications are investors have confidence that while the economy is likely to slow further as sentiment sours and the property market cools, this episode will not lead to full-blown systemic contagion, said Ms. Shah. Our belief is that the Chinese government is sensitive to the need to avoid wider financial risks and would not allow the Evergrande situation to develop into a Lehman-style scenario. The regulators already have considerable experience in containing risk posed by troubled institutions and will move to break the self-reinforcing feedback loops within the channels of financial risk, she said. Nonetheless, until there is a clear solution, Ms. Shah tipped international investors may sit on the sidelines. If bondholders are forced to the table to discuss a restructuring, all eyes will be on the way in which the discussions are conducted, as they will serve as a window into the extent of China's efficiency as an international capital market, she said. And similarly, AMP's Shane Oliver believes that there are several compelling reasons that suggest Chinese authorities will step in and prevent a full-on credit squeeze, including fear of social unrest. A collapse in the economy and property sector on the back of the pandemic could trigger a surge in social unrest, he said. Moreover, he's confident the Chinese government has learnt from the Lehman-instigated bust. The resolution of a renminbi debt payment due on the 23rd of September and the relative calm in China's own debt markets are possible signs that the Chinese authorities are working towards a restructuring, Mr. Oliver said. Last week, Evergrande Group's main unit, Hengge Real Estate Group, serviced an interest payment on the Shenzhen-traded 5.8% September 2025 bond. Henge's Shenzhen Exchange filing did not, however, mention the offshore bond, also due last Thursday. This still remains an enigma, however. The bond, of course, has a 30-day grace period. Investors are also keeping an eye out on the upcoming 29th September payment, worth a further $45 million for March 2024 notes. So depending on who you talk to, you can get very different perspectives on what's going on with Evergrande. But the broader point I want to leave you with is that the property sector here and in China is highly over-leveraged, and while things will be done to try and prop the market up, the question is how much effort, money, time, and government money in particular will be used to do so. And what are the long-term consequences of trying to keep the bubble alive for even longer? That is, of course, the question that nobody wants to talk about. But for me, having lived in a property bubble for at least the last 20 years means we can't necessarily see our way out unless we first realise that we're in a bubble in the first place. Now, if you're buying your home in Sydney's contentious market, you don't need to stand alone. This is the time you need to have Edwin Almeida from Ribbon Property Consultants standing alongside you. Buying a property is both challenging and adversarial. The vendor has a professional on their side. Emotions run high, price discovery and price transparency are hard to find, and then there's the wasted time and financial investments that you make. Edwin understands your needs, so why not engage a licensed professional to stand alongside you? With RPC, you know you have experience, knowledge, and master negotiators looking after your best interests. So shoot Ribbon an email at info@ribbonproperty.com.au, and if you use the promo code DFAWTW/Martin, you can get a 10% discount offer. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.